Hi everyone, 2022 has proven to be quite the year. Even though many of us are able to enjoy a greater degree of pre-COVID normalcy, there are still many reminders that days ahead might not get that comfortable just yet. After the fastest crash and recovery we observed in 2020, it definitely seemed like the worst was behind us. How then did we get here now in 2022 facing a decline where major indices are in correction territories? First, let's focus on interest rates and inflation. QE or quantitative easing, as we know, helped the economy and financial markets to recover quickly, but also created high inflationary pressures. Russia's invasion of Ukraine led to soaring energy costs and prices of key commodities to spike. Supply chain disruptions that became clear during the pandemic were recently exacerbated by China's zero-COVID policy. This brings upon major lockdowns in major cities such as Shenzhen, Shanghai and Beijing, further straining global supply chains. Now, the Federal Reserve decided to control inflation by increasing interest rates, delivering a hike of 25 basis points in March and a further hike of 50 basis points in May. Each hike slows down the economy by raising borrowing costs for businesses and consumers. This slows demand and supply, which will see businesses reducing growth forecasts. This leads in the next point being recession and stagflation. This seems to strike fear in most. Recession or stagflation is defined as periods of high inflation with little to no economic growth with high unemployment. However, the US and Singapore labour markets have continued to display resilience. Employers still face difficulties filling job openings, and we have seen modest wage growth. Jobs available remain at an optimistic level, whilst we remain hopeful that inflation is curtailed by the Fed's raising interest rates. So, what can investors do? There's three things to consider right now. Cover inflationary sectors using Custom Portfolio Builder. Some sectors that you might want to look at includes energy, real estate, commodities, consumer staples, supply chain, financials, and utilities. This list is non-exhaustive, and for further information, you can check out this other video here. Despite the disruptions caused by the pandemic and also recent rout in the financial markets, real estate value and demand in Singapore and most places have continued to grow. Real assets are shown to do well during inflationary periods. When we compare US REITs versus S&P 500 during different inflationary periods, we see REITs outperforming when inflation is relatively high. We will expect to see this trend play out in Singapore too. Income from real assets like REITs are generally tied to inflation. As leases and streams of revenues increase, this passes through to income. As economic activity increases, rents rise, utilization improves, and those benefits are passed on to the investor. While easing of COVID-19 measures in and resuming of global travels, we expect REITs of sectors such as commercial, retail, hospitality, and industrial to benefit. With the heightened volatility in the market, some investors crave safe havens, some even wanting to shy away from most bonds with the interest rate risk. Instead of holding cash in bank whilst waiting for an opportunity to enter the equity markets, Cash Plus can be the better alternative, earning you 1.2%. Otherwise, using the automated monthly transfer feature will allow you to dollar cost average effectively into other portfolios. We hope this video brings you clarity regarding what is happening and how you can better position yourself and stay on course towards your financial goals. Do remember that every investment journey comes with its ups and downs. There's no return without risk, so if you require more assistance, do reach out. We'll be here to help you.